Good morning, good morning, good morning. This is the morning after Ryan and, of course, Mr. Michael Brown. You join us for a very candid take and look at markets. We make no apologize for being rough around the edges. Nothing we say on the podcast is trading or investment advice. Hopefully, we add some value to your day. Hopefully, we put a smile on your face. Yeah, have I missed anything?
I don't think so.
I don't think so. How are you, Michael Brown?
Yeah, very good morning to you, Ryan. Good morning, everyone. All right, actually.
You sounded surprised by that.
Well, no, I am. I mean, even one of the guys on our risk desk said that you seem to be in quite a good mood this morning, which shows how rare it is. But yeah, I'm all right. It's relatively warm outside. I'm out for lunch today. I can't complain.
Let's not get carried away. It's not warm. It's just not as shit as it has been.
Well, look, it's not single digits and it's not raining. I'm going to take that as a win.
Is it not single digits? I've not ventured outside. I'm currently
11.
Wow. It's my mental age.
Nah, selling that.
That is single digits. Anyway, moving swiftly on.
Yeah, very swiftly. Clive's written a bloody novel for us, hasn't it?
Our dear friend Clive Lambert from Futures Text has written a novel today for his market update and level.
Je ne sais quoi, what he's thinking. But never mind.
God, I don't even know what that means. It's all French to me.
Right, to him as well.
Moving on. A mixed bag yesterday all round. Equities continued to post mixed signals depending on where you look. S&P saw red and returned to 68.45 once more. Grrr. I don't know why I put that. No, that was Clive.
A bear.
Nasdaq saw a big drop and still can't see off 25,045. DAX saw red but nothing too onerous. Eurostoxx 50 made a new all-time high at 6,162, albeit just. FTSE futures posted a doji, all wick, no body. Bund futures closed above 129.32 on Friday, which has cheered the bulls. Gains seen to. Hang on. Why is he talking about Friday's level? Oh, okay.
You all right there? Would you like me to carry on? You are reading the right one, don't worry.
Oh, I am, yeah. That was weird.
Yeah, no, it's definitely what he said this morning.
I just wondered why he mentioned Friday when yesterday was Monday. He's got
something else on his mind.
Do you know what? You took the words right out of my mouth then. In Forex markets, cable, moving on. In Forex markets, cable and Eurodollar both posted doji candles again. The former still holding its 200-day simple moving average support. Bitcoin bears doing their better work and gunning for 60,000 once more. Gold, yellow metal, got up to 5,270 overnight, where we found some sellers. Looking good to retest 5,627, the high from late January. Meanwhile, in silver, that rallied and closed above 84.74, the Fibonacci level we've been watching of late. So that's something for the bulls to get close to the March contract expiry, which seems to be attracting plenty of chatter. On the London Metal Exchange, Dr. Copper is trying to see off 13,030 this morning. Nickel, that's been nicely bid overnight. And meanwhile, in the crude oil benchmarks, should I say, Brent posted another doji. This is the May contract, the new front month, getting up to 72.04, where we found some sellers yesterday. 72.74 to 72.83 is the next strong resistance to gun for in Brent. Henry Hub over in the US, the natural gas benchmark, gapped up, but the bears responded and we posted a big slug of a red candle to keep them in the box seat. Meanwhile, this side of the pond, TTF, the Dutch European gas benchmark, gapped lower but recovered. Messy trade continues in that one. EU carbon markets was offered to keep the bear story alive and kicking that one. Corn over in the US tried to rally but found sellers at 4.45. And lastly, sticking in ag space, soybeans also saw some upside rejection yesterday and left a shooting star on the daily after a decent run higher of late. There you go. Thank you for that, Clive.
Very good. Thank you, Ryan. Thank you, Clive. Clive is looking for a text editor if anyone wants to volunteer for tomorrow, but there we are.
Please, because I got to read them out and sometimes I get very confused.
Well, it doesn't take a lot. As for markets yesterday, bit of a shaky start to the week, as Clive very well alluded to. The S&P and the Nasdaq down by about 1% apiece. Some of the tech software names getting a bit of a battering. IBM actually had its third worst day ever on the back of Anthropic releasing some Claude add-in that can recode various things that IBM used to do manually. I do just want to put a bit of context around the move, though, because everyone was getting very emotional and angry around the vibe that we saw in the market yesterday. The S&P was down 1%, which takes us to where we were literally this time last week. Again, we're not talking about a catastrophe. We're talking about a market that is still in the same range that we've been in since last October. That range has not broken, and we are still sat right in the middle of that 6,600 to 7,000 range. Also, again, a bit of context, we're about 2.5% off a record high, for goodness sake.
Yeah.
The number of people who are running around acting as if, this is the worst bear market we've ever seen, or markets are in turmoil or whatever. Yeah, certain parts of the market aren't doing very well at the moment, the tech names, the software names in particular. But, the broader market is still holding up very, very well indeed. I think we just need a little bit of context, and everyone just needs to calm down a little bit, if I'm being honest.
Yeah, no, exactly that, because obviously, and Citrini is a friend of mine in real life, someone that I have had many a drink with. And obviously people and we mentioned this yesterday, people losing their mind over his blog post. And, again, he made it very clear that this is just one scenario and it's a low probability scenario. People it made Bloomberg. Bloomberg calls it claiming that it was his blog that triggered the sell off and stuff like that. I'm like, people, like you said, people just need to get a grip. One thing I did mention yesterday, I can't remember if I did it on here or just I tweeted it. It's all a bit here in my life. It's just basically talking to you. But of late, because of every day we're almost waiting for Anthropic to release a new update that wipes billions off the stock market, or a new AI has decided to do this, that, or the other, like we were talking about yesterday, like Google coming in and just basically wiping out Indeed one day or something like that. It does, right now, trading the mega cap tech names, it does feel akin to trading bio stocks of the late 2000s.
Yeah.
Any day something big or something great or something disastrous could happen and your biotech name wipes 50% off. It does feel like that. And it kind of think maybe it ties into what we said last week. Like I said, it was a Goldman Sachs report or someone basically put out a piece and showing on a little graph, a nice little visual, that the mega tech names are in terms of real money, in terms of hedge funds holdings, the lowest allocation to these mega cap names. And is that indicative to just everyone just being a bit wary that it's all getting a bit silly? Everyone's like, well, look, let's just take our money off the table for now. Mega cap names aren't going anywhere, as in they're still going to be there tomorrow. And let's just wait for the dust to settle, because it is all getting a bit frantic.
Yeah, exactly that. And I think it's also, and I was halfway through writing a note on this before I came to do this podcast, so I'll finish off at some point this morning. And yeah, I'm no expert, right, on tech. But again, I come back to this fundamental point where the selling is almost indiscriminate in nature, whereby, fine, if we're sat here saying, the software as a service companies are going to get disrupted by AI models, becoming more and more intelligent on an exponential basis, that's fine. If that's your view, that's absolutely fine. I'm frankly not in a position to question whether that's a rational view or not. However, the logical assumption from that is, if that is indeed the case, we're going to need a hell of a lot more computing power, a hell of a lot more data centers, a hell of a lot more cooling and power for those and networking for those data centers in order to power these AI agents that are supposedly going to take over the world. So why is Nvidia lower? Why is Microsoft lower? Why is Alphabet lower? Why is Oracle lower? The selling has been almost too indiscriminate, which, again, to come back to your point, suggests there's not really a lot of rhyme or reason about what we're seeing. It's almost a market that's just kind of going, we're going to sell first and we'll ask questions later. And I think what would be really interesting is, if IBM, for example, they're down 12% yesterday. Let's see where IBM trade this time next week, this time next month, because I would wager that they've probably recovered a decent chunk, if not all of those losses, if you give that a long enough time period, once the market gets over the initial kind of shock factor that you price in as and when these headlines drop on a near daily basis.
Exactly that.
Anyway, moving on from that, we did have a fair few headlines on the trade front. Of course, Trump's Section 122 tariffs have now gone into effect. The tariff is actually set at 10% right now. The White House are, quote, working to increase the rate to 15%, which was obviously what Trump put in the Truth Social post over the weekend. We don't have an exact timeline for that 15% tariff, although do, of course, note that the entire Section 122 levy will expire 100 days from today, unless Congress renews that tariff. We did hear from Senate, Minority Leader Chuck Schumer yesterday saying that Senate Democrats would block any extension. I mean, that's stating the obvious, to be completely honest with you. But House Speaker Mike Johnson, who is obviously a Republican, he was also sounding a little bit bearish on the potential for the House to vote in favor of a renewal of those tariffs or an extension. So we will see how that one plays out over time.
Just on this, right? Because obviously when this first kicked off and they were like, oh my God, what is Trump doing with the tariffs? It's going to collapse the economy. The fact of the matter is, let's be honest, let's be objective here. The tariffs, all the tariffs he's put on, definitely did not, we can now see very clearly, that definitely did not collapse the economy. And in fact, looking at the inflation data, it's been nowhere near as bad as many of the horror stories that people were predicting in terms of tariff effects. And it is genuinely making the US extra money. So at this point, you could argue that, yes, at the time, everyone was like, okay, this is a bit OTT, he needs to be wound in. But the fact is, the tariffs have worked to an extent. Not all of the tariff increases have been passed on by the consumer. We can see that. The economy is still thriving to an extent, or at least certain areas are thriving. Stock prices are recalibrated. S&P, stock markets and capital markets are again 2% off all-time highs. It's you're kind of looking at it now and going, well, what benefit is there to actually protest against these tariffs? But not only that, but if they are successful and the reimbursements are forced to happen, that's going to cost the government gazillions.
Well, exactly, and I think the only real argument around tariffs now is in terms of the potential impact on hiring. Businesses don't know what's going to happen in 150 days' time. But having said that, that's the environment that we've been operating in for the last year now, where we don't really know what's going to happen in 15 minutes' time, let alone 150 days' time. So even that, slightly reluctant to kind of buy into the idea that anyone is going to massively or drastically change any hiring or investment plans based on the Supreme Court ruling or on the Section 122 tariffs or on what follows them, whenever that may be, whenever that is announced at some point in the future. But of course, we'll keep an eye on it. Anyway, just a few other bits and bobs from yesterday on the geopolitical front, a few things worth bearing in mind. The first is that the second US aircraft carrier, Gerald R. Ford, that is getting closer and closer to the Middle East. That is currently in port in Crete. Where it goes after that is anyone's guess, but it is nonetheless a lot closer to the Middle East than it was this time last week. Also continue to see plenty of sources reporting around the potential for military escalation in the Middle East. Axios had a story yesterday saying that the chairman of the Joint Chiefs of Staff, who's of course Trump's kind of main military advisor, has reportedly been advising President Trump that a military campaign against Iran could carry significant risks, particularly the possibility of becoming entangled in a prolonged conflict. I think this is very much something that a lot of people have been flagging, whereby Venezuela, which is the most recent sort of US military intervention, was very surgical in nature. The risk is, of course, that Iran will not be so surgical in nature and that the US could get drawn into another sort of elongated conflict in the Middle East. President Trump actually came out on Truth Social shortly after this story broke. He was basically saying that a lot of what the media have been reporting is fake news. And he was also saying that basically I'm the only one who makes the decision as to whether we strike or not, which we kind of knew anyway. A couple of other headlines just worth noting before we move on. We did hear from Fed Governor Chris Waller yesterday, actually sounding marginally more hawkish than he has in recent remarks. Waller was noting that the January jobs report, of course, 130,000 jobs, unemployment down to 4.3%. He called that a welcome surprise. He then noted that whether or not he votes in favor of a rate cut in March will hinge on the February payrolls report, basically saying one report, good news, but we're not going to overreact to it. If we get two reports that are a welcome surprise and good news, then I'll probably tilt in favour of holding rates steady. Of course, recall that Chris Waller did indeed dissent for a 25 basis point cut at the January FOMC meeting. He also said that the Supreme Court tariff ruling is unlikely to impact interest rate policy, which I think is probably going to be the view of the majority of Fed speakers that we hear from this week. On the corporate front, PayPal, they are reportedly attracting takeover interest. Their stock has just fallen off a cliff in recent weeks, to be completely honest with you. And as a result, Bloomberg sources reporting that a whole host of suitors have showed preliminary interest in an acquisition of the firm. Those suitors were, however, not identified. And then just a couple of stories out of Japan overnight, which will lead us quite nicely on to our discussion. The first is the Nikkei confirming that the January rate checks in dollar yen were indeed initiated by Treasury Secretary Scott Bessent. This had been alluded to in the January Fed minutes, but that has now been confirmed. And secondly, a story that's broken probably within the last 90 minutes or so is that in this meeting between Bank of Japan Governor Ueda and Prime Minister Takaichi last week, according to the Japanese press, Takaichi, quote, voiced apprehension to more Bank of Japan rate hikes. As a result, relatively predictably, we've seen some fairly significant weakness coming through in the yen. Dollar yen was trading beneath the 150, just beneath the 155 handle when that news broke. We have since traded up to a high of around 156.25. So about a big figure, just over a big figure of weakness coming through in the yen on the back of those comments. And that leads us on quite nicely to a broader theme, which is the fading or the erosion of central bank independence, not just in Japan, but across the world.
Exactly that. So our topic du jour, and we were running out of ideas, so thank you to Tom for prompting this one. And again, as Michael said, if you've got any ideas for topics of the day, do shout them out, because we do get stuck sometimes. But today, it's the central bank non-independence kind of movement that we're seeing, and the myth that's unraveling in real time. So the thesis is that kind of we're witnessing what is arguably the most coordinated erosion of central bank independence across major economies since these institutions were made independent in the first place. You know, 3 of the big 4 central banks in the world are facing direct or indirect political pressures, which is the Fed, ECB, and the BOJ. Shout out to the BOE that seems to be remaining independent much more than anyone else. Well, at least arguably the least compromised out of the major 4.
Yeah, well, that's because Rachel Reeves couldn't find the BOE on a map, let alone try and tell them what to do.
Yeah, is that she'll walk into the Royal Exchange and set up at the Fortnum and Mason's counter,
start making the tea again, like she was when she used to work.
But yeah, obviously we've got a Fed, the most brazen assault. We've got the ECB, which is pretty much a stitch up in plain sight, with Lagarde looking to step down before her term expires, so that Macron can choose a replacement. Something that Bloomberg called, was it, quote, a transparent stitch up. That's Bloomberg's words, not mine. And obviously we've got BOJ. So Mike,
I do think.
Go on.
Sorry, you were going to invite me in anyway, so I shan't apologise. I think the ECB one, I think across the sort of G4 central banks, as you say, the BOE we can kind of ignore because the big man is doing well, that kind of last bastion of central bank independence. Go on, Andrew Bailey. However, I think the ECB one is really interesting because, generally speaking, when we talk about policy independence being eroded, what we effectively are sort of euphemistically alluding to is governments trying to tell the central bank what to do. Whereas the ECB situation is kind of the other way around at the moment, where it's actually being eroded almost from the inside out or from the top down, because you've got President Lagarde, as we've mentioned on numerous occasions, suggesting that she may, or sources suggesting that she may leave her term early, effectively to engineer this political stitch up. So unless there's some backroom conversations going on where Macron's saying, "Oi, Christine, on your bike, love," which may well be happening. I think that was really interesting, that actually it's coming from inside the institution. And again, Christine Lagarde was speaking yesterday. She regurgitated all the usual lines around, policy being in a good place. We've got to be agile in terms of our response to inflation. She was again asked, "Are you going to see out your term?" And she goes, "My baseline is I will." You're not denying these stories. And I think that's really, really interesting. Well, this must be, 4 or 5 opportunities she's been given now to just shut this down, and she hasn't done it.
And like we said last week when we spoke about this, when she first used this line, Yes, of course your baseline is that because that's what's written in your contract.
Yeah.
So all she's basically saying is a different way of saying, well, that's what my contract says. That's all she's saying. She's not saying her opinion or anything like that. But we've mentioned a couple of times, and obviously you've just mentioned again there that potentially the reason she might leave early is so that Macron gets a say in who's going to replace her, yada yada yada. But I think something else that's worth considering is she leaving early so that she's a contender to replace Macron?
Well, I mean, if what's Macron's party called? I can't bloody remember now. But if his party were going to lose the election anyway, then would you like to guarantee certain defeat? Because that's that would literally guarantee defeat for them. But, I mean, I know she's not going to be thinking like that, but
Michael, it's all about positioning. We're all about the right position.
Yes,
and the thing is,
on march. There you go. Thank you, Tom.
And the French do love, a convicted criminal in charge.
Well, yeah, they do. She would fit in. But I do think the other sort of interesting divergent. Well, actually, between the Fed and the Bank of Japan, although the policy rate is being moved in opposite directions, of the Fed are in an easing cycle, the Bank of Japan are in a tightening cycle. The common thread between both of those is the person in charge, obviously Trump or Takaichi, wants lower borrowing costs.
Yeah.
And I think this kind of feeds back to a broader theme, actually, that we see everywhere. We say that the Bank of England are independent, but this theme, I think, still applies, is that as opposed to taking the difficult decisions from a fiscal perspective, in terms of reining in spending or higher taxation or both, actually leaders across the developed world are effectively abdicating that and going, do you know what? These are really tough choices that are politically unpalatable. If I raise taxes, I'm going to annoy this cohort. If I cut spending, I'm going to annoy another cohort. If I do both, I'm going to annoy everyone. The easier option from a political perspective is probably to go, actually, lads, do you know what? I'm going to blame that person over there who doesn't have a right of reply and try and pressure them to do what I want and get me out of this hole that I've made myself and that my predecessors have dug for me over the last decade or two. And I think that's the kind of common thread that runs through all of this. It's effectively elected officials who are in those positions of power not being able or not being willing or whatever it may be to take the tough choices to actually balance the books. Because, it's all well and good trying to engineer lower rates, and you may get that. That may be a sort of short sticking plaster approach, but fundamentally you can't be running 5, 6, 7% of GDP deficits when we're in a quote unquote normal part of the business cycle. That's just unsustainable.
Well, maybe this is why the BOE are kind of, the last bastions of being independent, because they are doing what the government wants, but the government doesn't realise that they're doing it because the government are fucking up.
Go on, sorry. Well, I was going to say they are from a rate perspective, but actually, if you look at the long end of the gilt curve, the BOE have cut rates 5, 6 times now, however many the government claiming credit for. But the 10-year gilt yield is still above where it was when they delivered the first rate cut.
Well, again, that's because everyone's like, well, we know this is going to end poorly.
Clearly.
And but I think that's, but annoyingly for us, we've got kind of the Labour, the cabinet, the senior people in the Labour Party and all Labour MPs claiming that Bank of England cutting rates is great news for the UK economy, but just ignoring the fact that the reason they're cutting is because things are deteriorating. But anyway, I think it's definitely one we've got to keep an eye on. But, is it just reverting back to the norm when we think about historically, these central banks have only been independent for a very short time?
Well, the Bank of England was, 1997, I think it was? Yeah.
Yeah, indeed. And so it's like 300 odd years of being not independent. And we'll see what happens.
Yeah, I would also stress, just lastly on this one, I don't see this as a tradable theme. You're going to get short-term volatility like we saw today, the yen falling off a cliff on the back of Takaichi putting some pressure on the Bank of Japan. But I don't think you could sit here, for example, and go, right, this morning I'm going to put on a massive treasury short or a steepener or whatever you might want to do based on the idea that Fed policy independence is dead. This is the sort of thing that pans out over months, if not years, if not decades. It's not something that, you can make money on by pub time today.
Yeah, no, exactly that. Although what people will be shouting into their speakers or phones about what you said, that would be, you're wrong, Michael. Long gold is the trade against central bank independence eroding. But yeah, but that's more, like you said, that's more, if you wanted to take that view, that's an investment theme, not a day trade to make money out of, central banks not becoming less independent.
Yeah, no, absolutely. It's a secular theme.
Oh, nice one. Right, moving on. What have we got to look forward to today apart from the pub?
Yeah, not a lot, to be completely honest with you. The data docket is very, very light most days this week, and today is absolutely no exception. We have no notable releases from either the UK or the Eurozone through this morning's session, and from the US this afternoon, we are kind of feeding off scraps as well. At 3 o'clock this afternoon, London time, 10 o'clock on the East Coast, we will be getting the monthly Richmond Fed manufacturing figures. That index is expected to have held steady at -6 in February. We'll also get the monthly consumer confidence numbers from the Conference Board. That index is expected at 87, up from a prior 84.5 in February. Do recall, of course, that the January consumer confidence print, that was the lowest since, I believe, 2014. So we are looking for a bit of a rebound on that front. Besides that, the US will be selling 2-year notes at 6 o'clock this evening, London time. That comes ahead of a 5-year sale tomorrow and a 7-year sale on Thursday. There are plenty of central bank speakers in the mix today, including the Fed's Barkin, Collins, Cook, Waller, Bostic and Goolsbee. And we also have 4 of the Bank of England's Monetary Policy Committee who will be testifying to the Treasury Select Committee, namely Governor Bailey, Chief Economist Pill, external members Taylor and Green. We heard from Alan Taylor yesterday, who was noting that there are probably 2 or 3 more cuts to go before bank rate gets to a neutral level. And of course, we'll be looking to Governor Bailey's remarks in particular, given that he is the swing vote on the MPC, to see whether he endorses or at least leans into the idea that the bank could deliver a rate cut at the March meeting. Sterling swaps priced at around an 80% chance at this moment in time, with about a month to go until that meeting. And on the earnings front, lastly, before the market opens today, we hear from Home Depot, or Home Depot if you speak English properly. They are a useful bellwether for the consumer at large. And of course, that report comes ahead of this week's earnings highlight, which naturally comes from Nvidia after the market close on Wednesday. But for this morning, I think that is all from me.
And that's all from me. Michael, as usual, pleasure.
Oh, sorry, he's right. I've just seen that. Yes, it is the State of the Union. I think that's at 2 o'clock this morning, or 2 o'clock Wednesday morning for those of us here in the UK. I don't really anticipate that being market moving, to be completely honest. Trump's just going to stand in Congress for an hour and a half, slagging off the Supreme Court, talking about how brilliant the American economy is doing, etc., etc. But just one to keep on the radar nonetheless. It's an event that's typically made for TV as opposed to being made for the consumption of investors. But it is a risk, and thank you to Tom for flagging.
I'll tell you what, though, it'd be absolute cinema if he decided to launch the first wave against Iran whilst that's going on.
Oh, Christ.
But there we go. I'll be in the pub.
What? 2 a.m. you put.
It's not impossible. I'm in London all week, so yeah, there's very, very likely.
Oh no!
Right, on that note, I'll get ready for the pub. Michael, absolute pleasure as always. Listeners, thank you so much for tuning in. Hopefully, we've added a bit of value. Hopefully, put a smile on your face. Go out, seize the day. Be careful. Wrap up. Coats. Obviously, I'm not talking about sexual protection, although that is advised if you are.
Goodbye.